Nutanix, ticker NTNX, they delivered a pretty comprehensive beat on consensus for Q4 fiscal 2026. Revenue hit $757.1 million, so that easily clears the $738.3 million estimate. And non-GAAP EPS came in at 60 cents.
Which just crushes the
Yeah.
the 49-cent consensus, yeah.
Right.
And the forward guidance is honestly just as aggressive. For Q1 fiscal 2027, they're projecting operating margins between 26 and 28%.
Oh, wow.
Yeah, and full year 27 revenue is guided at like $3.18 billion to $3.23 billion, and free cash flow is expected to land between $850 million and $950 million.
Okay, so the stock reaction makes total sense then. A share spiked over 10% after hours and then closed the next regular session up 6.93% at $69.92. But what really stands out there is the volume, right? Like 1.9 times the normal daily average.
Yeah, well, that volume is institutional money reacting to the operating leverage we're seeing. Non-GAAP operating margin hit 26.2%.
Which smashed their internal guidance of what, 21 to 23%?
Exactly.
Yeah.
But to understand why the big money is paying so much attention, we have to look past the top line beat. We need to address that massive anomaly sitting in the GAAP numbers.
Right. Because if you're just glancing at the print, you see this crazy $1.27 billion in GAAP net income generated on just $757 million in quarterly revenue.
Yeah.
I mean, for anyone parsing the income statement, that just looks impossible.
It does, yeah. It's a one-time deferred tax asset release.
Yeah.
Because Nutanix has now, strung together a 3-year track record of sustainable profitability, accounting rules basically allow them to cash in past operational losses to lower their tax burden.
Okay, I see.
So it is a non-recurring accounting maneuver, but structurally it signals to the market that they've officially crossed the threshold into sustained GAAP profitability.
Yeah, but that's just an accounting milestone, right? I mean, the real engine driving that profitability is the core software business. Annual recurring revenue, or ARR, that grew 16% to $2.55 billion. And looking at the sources, that growth seems directly tied to how they are honestly kind of weaponizing external storage support. They've aggressively integrated with legacy hardware from Dell, NetApp, Everpure.
Which fundamentally changes the sales friction for new enterprise clients.
Right.
Because following Broadcom's acquisition of VMware, corporate clients are staring down these massive licensing cost increases. They desperately want to migrate away from VMware.
But standard data center refresh cycles usually mean, buying millions of dollars in new servers just to support a new software ecosystem.
Exactly.
That capital expenditure was this massive bottleneck keeping customers locked in.
Right.
So Nutanix essentially rolled out a bring your own device policy, but for enterprise IT. Like, instead of forcing a company to rip and replace their entire data center to switch software, Nutanix just lets them keep their existing storage arrays.
Yeah, and they just run their software on top of the old hardware. So by decoupling their software from the physical hardware procurement cycle, Nutanix removed the upfront capex of migrating.
Right.
They're directly capturing that displaced VMware market share because they made the off-ramp incredibly cheap.
But capturing that market share still requires heavy operational investment. Like, management is actually executing a 5% global workforce reduction this quarter.
Yeah, taking a $33 million to $43 million restructuring charge to do it.
Right. But they aren't shrinking just to pad the bottom line, though, are they?
No. They're taking those specific payroll savings and aggressively redirecting them into high-margin growth vectors. They're heavily reinvesting in agentic AI capabilities to automate IT tasks, and cloud-native container orchestration to manage applications, and these specialized sales teams whose sole mandate is to hunt down those massive VMware displacement deals.
Well, let's talk about the friction on this displacement deals, though, because management openly flagged ongoing server supply constraints as a pretty notable risk. Hardware inflation is up. By 86, server lead times are stretched. If clients can't get new hardware online, Nutanix is having to issue future start dates for their software licenses and shift to flexible annual financing rather than getting paid for multi-year deals up front.
Right.
I mean, doesn't that deferral severely bottleneck their near-term cash flow? Cash conversion is like the lifeblood for software valuations.
It is, yeah. Moving away from upfront multi-year payments absolutely delays cash velocity. It's a very real risk when you're simultaneously restructuring and investing heavily in AI and sales.
Right.
But the counterweight here is the sheer scale of the recurring revenue they've already locked in. Their $850 million to $950 million free cash flow guidance for 2027 explicitly absorbs the hit from these flexible billing structures.
Oh, I see. So they can afford to play the long game on cash collection because their existing pool of predictable annual subscription renewals is finally large enough to provide this massive cash flow cushion.
Precisely. They are using their massive recurring revenue base to essentially subsidize the financing flexibility they need to win those new VMware defectors.
Right. That recurring revenue engine is what gives them the flexibility to be aggressive while competitors are kind of scrambling.
Yeah.
So for all the retail investors out there trying to catch these shifts in market share, make sure you follow the show for our daily earnings coverage.
And as we watch this play out, it leaves us with a much bigger question for the data center industry. If software platforms like Nutanix successfully decouple their value entirely from hardware procurement cycles, will traditional x86 server manufacturers eventually face total commoditization, losing all pricing power in the process?